All right, we're rolling. Hey guys, how's everyone doing? This is Hala Pablo. I want to talk about bear cycles today. Bear cycles, real quick. Bear cycle. There's a lot of confusion about bear cycles, especially for new traders who aren't used to this sort of these sort of dumps, these sort of depressions. What's going on with crypto? Why is Bitcoin? Why does Bitcoin rally only to fall back down? Why can't we just break this trend and just send Bitcoin to the moon and all of crypto? Wouldn't that be great? But it's not happening. How long can we expect this stuff to last where we're down in the dumps like this with a bunch of red candles? All right, so that's what we're going to talk about today. If this is your first time trading, this is your first bear cycle, bear market. Yeah, there's a lot of misinformation swirling around out there by newbies who just don't know how this stuff works. Basically, I found that the XLM, which is Stellar Lumens, has a very great. If you go to the daily in which is a higher time frame, you scroll out, you get this chart here where it's just wonderfully condensed. You have two bull cycles and two bear markets. Now the first bull cycle goes back to November of 2017 when crypto really started taking off, and so we see this cycle here, and then this bear cycle, this depression. So we have this distribution and this accumulation range, and then which fed right into another markup, and we have a macro bull cycle, which goes back into where we are today. It is into the accumulation bear cycle. And then we have it to a smaller extent back in here prior to 2017, before crypto was really a thing. When I say that, I mean caught the attention of smart money, institutional traders, and things like that. So things are obviously different now. For example, the accumulation ranges are much more protracted now that smart money is involved as to prior to 2017. Yet the structures are the same, and that's what I want to talk about today. The basic outline, the schematics, if you will, of an accumulation range. So we know that tops are distributions. We have two tops here, and the bottoms are accumulations. So right now we are in an accumulation range on the macro. So what does that mean? That means that smart money institutional investors are accumulating the token or the coin or whatever, the stock, whatever it is that is being traded. If it's a bear market, it's that stock, that commodity, whatever it is, the crypto is being accumulated or bought up, and smart money investors are establishing their positions as we speak. So that's what all this is. Now the thing is, these periods of accumulation can be very long and drawn out. We see the last one here lasted 780 days. I counted that from the final sell-off of this bull cycle to after the last sucker rally. I call sucker rally. That's not the official term. That's just what I call it. I have all my I have my own names for certain things. For the most part, by and large, I go off of the Wyckoff, like primary support, selling climax, automatic rallies, upthrust after distributions, terminal shakeouts. All that's good. But then I've noticed there's a trend right at the very end of these accumulation ranges, when you think we're finally out of the woods, we're out of the haunted forest, and we're going home. Boom, we get this huge FOMO rally, and you see that there's a lot of buy orders that come in, and people are thinking, wahoo, we're going into space, and it ends up being a sucker rally, and it comes right back down and retests the old trading range resistance, which has now been flipped to support. And then from there it bounces, and there starts the the bull cycle macro proper. We see that happened here, and it happened back here too, we'll go ahead back in prior to 2017, this last cycle here, we had the terminal shakeout and see the sucker rally at the end. Now, this was much shorter than the 780-day accumulation ranges that we've been seeing. But so this was almost like half that, I guess. But you see there was a sucker rally where it came back up and then it came right back down, retested the trading range support now because it had flipped the resistance to support. And then from there it bounced and it started the what we know today as the bull cycle that began in 2017, in November of 2017, nearly 6 years ago. So, okay, but so going back to today, well, we'll go back to the last macro accumulation cycle. We see in many of these that the accumulation ranges start off with a pronounced rising wedge. Now, we see this right now. Bitcoin is in a rising wedge. If you've seen my videos, go back and look. I'll have some links on this video to the recent Bitcoin technical analysis videos that I've done. In fact, I did one 2 days ago where we are in the midst of this wedge. See this rising wedge? A rising wedge is a crooked top, in essence. Now, I know it sounds strange to say we're in a top, but we're accumulating. Well, in the macro, yes, there is a grand accumulation campaign going on, but within these macro ranges, there are rising wedges, there are structures, there's falling wedges, there's all kinds of bearish and bullish geometric patterns. And we know that rising wedges are fundamentally bearish. So all rising wedges are, like I said, are crooked tops. We have a series of higher highs and a series of higher lows that sometimes are widening as they go up on the incline, and other times they're narrowing. The spread is narrowing in the candles. So normally at the beginning of these accumulation, aka bottom ranges, we see rising wedges. We saw this here even prior to 2017. This is a rising wedge where the price action went up. And what it is it's a counter trend. It's a trend. It's a counter trend. The trend is downward. It's a downtrend because we're in a bear market. So, but within this bear market, we have bullish counter trends, and that makes up the rising wedges. And so we are still in this wedge. Everyone's saying, Bitcoin's pumping. It's pumping, but it's pumping in a counter trend. It doesn't mean that we're out of the haunted forest. It's like you're walking along the trail and you come to a break where there are trees and the canopy moves and you can see the sunlight and you're like, we're out of the haunted forest. No, we're not. We're just in a little clearing. If you keep walking, the shade comes back and we're far from out. So anyway, we are here in the midst of this rising wedge, and at some point the rising wedge breaks and we come back down to retest or mitigate the prior lows. This happened here prior to 2017. It happened here where we had a terminal shakeout in 2020. See how it broke out of this rising wedge? And the rising wedges are also, we have the selling climax and the tests, a series of tests, rallies, automatic rallies, which goes up and defines in this case, it would be the macro trend resistance, comes back down for a series of secondary tests, 1 and 2. We have that here. See the 1 and 2s here in this smaller range, and even in today's range where we're in our present accumulation range today. We have the selling climax. Here's the selling climax, automatic rallies, up thrusts, and then a UTAD, which comes back into the range, brings the price back into the structure. And then usually at this point, we could have another rally within intra wedge, but at some point we're going to break this, we're going to come back down, break out of this structure here, and let's see if I can get this so I can draw this out. Break this structure, maybe go up to here, I don't know, and come back through, and we're going to retest, which is going to constitute the technical shakeout. So, and then that could oftentimes go lower than the selling climax, like it did here, and I think it went lower also in here too. Yeah, it did. See, if you blow it up a little bit. The technical shakeouts usually go deeper than the original selling climax, which began the bear cycle. And so that's to get everyone to capitulate. They want all these buyers here to sell their bags thinking we're going down even deeper. And so they sell, and then smart money scoops it up at the terminal shakeout. And then from the terminal shakeout, this is actually the area where the real bull macro reversals happen. Because from here, it's up, up, up. Never again do we hit this low. We see it here. It's up, up, up. Never again did it hit that low. It just went up through the trading range. And we're going to see the same thing here, I believe, if we follow the patterns. That seems to be the patterns of all the bear and bull cycles since they started like charting these out, Richard Wyckoff and those guys. So from back in the 20s and 30s. So human greed, and it's fear and greed, basically, which propels these prices and causes them, since the human nature doesn't change. Things change, technology changes over the years, but one thing doesn't change: humans are greedy, humans are fearful. So, and because of that, these are basically a visual representation of the buying and selling of the emotional dynamics of a trader. So, unless people have changed, we can expect the same thing to occur in this cycle as well. We're going to come back down, hit a terminal shakeout, and then from there we can expect the real macro changes to occur, where we're now in a bull cycle proper. This was 780 days from the last dump. This is the previous cycle from the last dump, which started which amounted in the selling climax to the end of the sucker rally, where we came back up and started the proper bull cycle. It was 780 days for the last cycle. We're about this is 780 days, so you see we still have some length to go if we're going to mimic last year. And this is no way says that we're going to do the same thing as we did last year. In fact, that would be odd. But there should be some degree of semblance of what we're going to do, so we can expect the price action to behave more or less within the same parameters. Maybe instead of 780 days, we might do 645 days. We might do 812 days. There's going to be variations within it, but one thing is for sure: we should go down, retest the prior lows, which is going to bring the price action deeper than the selling climax, which happened back in December of last year. So that might happen in December of this year. That might happen next month. It might happen. I'm thinking it's going to happen probably in December or January, and then from there the slow build up. So everything, we're right on course. These things take a while, guys. Expect lower prices. Expect another rally, certainly within the rising wedge, before we break structure and come back down. The thing is, don't be a sucker. Don't buy the tops of these things. Don't buy into what people who don't know how to trade are saying, that, Bitcoin is going straight to 100,000 next month or whatever, just because we have some macro rally that breaks 35, 37, even $40,000 Bitcoin. It doesn't mean that we're out of the forest yet. We're still trending within these rising wedges, and we're going to break these wedges eventually. We have to, because we need to form this bottom. The bottom needs to be protracted. If you look, bottoms need to be protracted. It's almost 2 years sometimes it takes for these accumulation campaigns. Why? They need to build this foundation. It's like, look at these structures that come afterwards. Look how high these tops are. Look at these mammoth bull cycles. In order to sustain this sort of price action, you have to have a deep foundation. It's like if you're going to build a skyscraper in the city, you need a big foundation. There's a lot that goes underneath the ground to support the structure. The higher the structure, the more substantial the support needs to be. So people thinking 100,000, 200,000 Bitcoin off a tiny foundation, there's no way it can be sustained. What these can sustain are counter trend rallies that can go considerably high, but they're on wooden legs, so to speak. And they're destined to fall. They're destined to fail. They're FOMO rallies, sucker rallies. Don't be a sucker. Don't buy the tops of these rallies. Wait. By all means, you could day trade, you could impulse trade, you could scalp the price action momentum trade within the wedges here, but don't fall in there any kind of delusion of holding. If you're going to buy, of holding, thinking we're going up from here and we're going to start the next bull cycle. That's not going to happen. We're going back down actually pretty deep. This country's going into a recession, and the world, I believe, and so that's going to be reflected in early next year, February, March, something like that. But rest assured, the reversals are coming. Crypto's not going anywhere. The United States government is trying to bring volatility. The Securities and Exchange Commission is trying to bring volatility into crypto to make it tank, to make the prices go down in preparation for the Fed coin CBDC rollouts. And when that happens, they want crypto to just look deplorable, so people have no faith in crypto and instead have faith in the federal government-backed CBDCs. So, but anyway, that's a whole other tangent there. But just be patient, strong hands, ride out these bear cycles, and the reversals will come. I guarantee you. So anyway, that's about it for now. 15 minutes. Oh, I went over a little bit. Hey guys, if you like this, like, subscribe, check out my trading history, 80 to 85% win rates on TradingView. And I put my money where my mouth is. I don't enter any trades that I don't put my own money in. You can see all my trades, my complete. I have almost 500 charts in my Hala Pablo TradingView account, and you can see 80 to 85% win rates. And I also teach. I also have a small trading group where I share my signals. So, all right, if you guys got anything out of this, like, subscribe, and we'll talk to you soon. All right, guys, and none of this is financial advice, but you already knew that, right? Okay, bye-bye. We'll talk to you soon. Adios.